Hi, I'm Mike Mercer. I'd like to welcome you back to Empower You. This Tuesday night, our guest will be John Carney, who's the finance and economics editor at Breitbart. And John will be giving a talk about the Fed. So he'll be talking about what's going on with the Fed, recent dynamics in the past few years, including the Biden administration, how things look for the future. And we'll be, as usual, taking questions from the audience. So please, if you have any questions on any aspect of the Fed you'd like to ask him, you can do that throughout the discussion on the chat. And we'll try to get to those questions as we go. Now I would like to move on and formally introduce John Carney. So John, as I mentioned, he's the finance and economics editor at Breitbart. He's also a co-author with Breitbart's Business Digest, which is a daily business newsletter that's free. He has deep experience in corporate finance and financial journalism. So he started off as a corporate lawyer. He was structuring the financing of mergers and acquisitions. And then I think it was about 2006, he broke into financial journalism with a new blog called About Wall Street. And from there, he went to a number of brand name financial news organizations, including Business Insider, CNBC, the Wall Street Journal. He actually was an author on the famous Heard on the Street column. And also his work, his articles have appeared in the New York Times, New York Magazine, Fortune, New York Post, the Sun, New York Sun, Observer, the Atlantic, the Daily Beast, and the American Conservative. So, John, I'd like to welcome you to Empower You.
Thanks for having me. What a great program you guys have. Just listening to all the things. Man, I want to sign up the Sebastian Younger, the Scotch tasting. This is great. Great stuff.
Yeah. We have a broad spectrum of topics that we cover. We do a lot of politics, a lot of political and social issues, but we do other things too. So, but we're really thrilled. We have a relationship with Breitbart, and we usually have 2 or 3 people from Breitbart join us, and we really appreciate it. And I listened to your interview with Brian Thomas this morning, and I'm excited about this because I think it's given all the inflation we're experiencing, everyone has an interest in knowing what the Fed might do. So I've made it clear to the audience that they can submit questions at any time, and if they're appropriate at that moment, we'll get to them. If not, we'll hold them off. And so just feel free.
Sure.
To hear you talk.
So why don't we start in the near term, and then maybe I'll broaden out the talk a little bit to talk about what's happened over the last couple of years. The Federal Reserve is having a meeting next week where they will decide whether or not to raise interest rates again. And there's been actually a lot of volatility about the market's opinion about whether or not they will cut interest rates. Sorry, I said raise a moment ago. Whether they will cut interest rates at this December meeting. They cut in September, which was the first time they cut this year. They cut again in October. And in the October meeting, Jerome Powell, the Fed chairman, made it very clear that it wasn't certain what they were going to do. And the market had more or less baked in that they were going to cut in December. And so when Jerome Powell said, well, it's not clear what we're going to do in December, the market immediately took that to mean, okay, we're not going to cut in December. Why would he be saying it's not clear if they were going to cut, or even if there's a possibility? He seemed to be trying to talk the market out of that. That actually may have been an overreaction. He may really have been, we don't know what we're going to do. That's one of the problems of being the Fed chair is people listen to every word you say. I've often remarked that it's a little bit like people used to be Kremlinologists back when we had a Soviet Union, and people would pay attention to like who got to stand next to Stalin, right? Like that was how you knew who was on the ups, and eventually their picture would, they'd disappear from the pictures. They wouldn't be seen at all. But, people pay so close attention to what every word the Federal Reserve Chairman says, in part because he does have almost the totalitarian power over our money supply. Not complete totalitarian power, and we'll talk about that as we go on. But there's not a lot of organizations in our government where somebody has the power to do what the Federal Reserve has the power to do, which is basically to set interest rates and control the money supply. They are subject to two very broad, it's really three, but people call it a dual mandates that were set by Congress in the 1970s. And those are, before that, by the way, it was not exactly clear what the Fed's mission was. The Fed was established. It was to provide some stability to the banking system, but exactly what their public purpose was not clear. In the 1970s, Congress said, "Okay, we're going to make this clear. We're going to say you have to maximize employment in a keep interest rates reasonable and create the conditions of price stability, which means low inflation." But those are very broad mandates, and nobody really quite knows what they mean. The Federal Reserve, more recently in the last 20 years, has made it clear that they think price stability means 2% inflation. So it doesn't mean no inflation. It means 2%. But again, that's not written in stone anywhere. It's actually barely written down at all. The Federal Reserve has said that's what their target is. They have a statutory obligation to do price stability, and they say, we think 2% is consistent with our obligation to do price stability. So Jerome Powell, again, he has a lot of power as Fed chairman. He hinted that he might not raise interest rates. So the market immediately started to discount the idea that they were going to might not cut interest rates, discount the idea that they were going to cut interest rates in December. So more recently, over the last week or so, a couple of people who are considered pretty close to Jerome Powell, the head of the New York Federal Reserve Bank, John Williams, and the head of the San Francisco Federal Reserve Bank, Mary Daly, both indicated that they think maybe the Fed should cut in December. This was in contrast to a bunch of Fed presidents. And before I go on, I'll try to describe the difference between that. Fed president, there's regional Fed banks all over the country. There's an Atlanta Fed, a Boston Fed, a Philadelphia Fed, a New York Fed, a Kansas City Fed, and San Francisco Fed, Dallas Fed. And they are elected more or less by the local business communities. And that's how they get to be the head president of the Fed. And then there are Fed governors. The Fed governors are appointed by the president. They are confirmed by the Senate, and they serve very long terms, 14-year terms, which is incredible. I mean, it's almost a lifetime tenure. They are the Supreme Court of monetary policy, is the way I'd put it. So you had all these Fed presidents say, we think maybe we won't raise interest rates. Then you have these two very important Fed governors, San Francisco and New York, say, or we won't cut interest rates. They say, we think we might cut interest rates. That was interpreted as the Fed saying, as basically Jerome Powell saying, okay, we're probably going to cut. Because if these very important and also considered close to Powell president, Fed governors are indicating that they're going to cut, then probably they are going to cut. And if Powell wanted to, he could have reined them in. He could have said, guys, don't go out there and say that. The market will price in cuts are coming. The market right now, there's a thing called the Fed funds futures market where you can more or less literally bet on whether the Fed is going to cut. And that is predicting an 89% chance of a Fed cut next week. So the Fed doesn't like to surprise markets very much. So if the Fed was not going to cut, we would have had Jerome Powell or somebody else say over the last couple of days, we are not going to cut next week. They go into a quiet period. They call it a blackout period. Maybe you guys will have your blackout period after your scotch taste. But the blackout period is where no Fed people can speak. It's right before a meeting, a week before a meeting, basically they silence everybody. Say, don't talk anymore. Okay. Like we want everybody to wait for the meeting to find out what's going to happen. So the last 2 days, everybody was watching. Will there be some sort of pushback? The market is pricing more or less a 90% chance of a cut at the meeting next week. If the Fed isn't planning on cutting, if Jerome Powell doesn't think they're going to cut, if John Williams, the head of the New York Fed, doesn't think they're going to cut, if Mary Daly doesn't think they're going to cut, we're going to hear from them. But we didn't. So that's how you get the idea that, yes, they're definitely going to cut next week. The question then becomes, what happens after? The most likely outcome, I think, is that the Fed meets in January, then they meet again in March, and then they meet again in April, and then they meet again after, and Jerome Powell's term ends at the end of May. I don't think they're going to cut at all after December. I think that will be Jerome Powell's final cut. He will then wait, in part to show his independence. He really has ended up as this, in an almost psychological battle with Donald Trump, where Donald Trump has been pushing him to cut. My friend Larry Kudlow likes to describe this as working the refs, right? Like Donald Trump it's like a coach who keeps, criticizing the refs' calls. You're hoping that you'll influence them a little bit. So Donald Trump's been working the refs. Jerome Powell is the ref who wants to show he's not going to be influenced by this. So I think he doesn't cut. The market thinks there's like a 50% or so chance that they cut in Jerome Powell's final FOMC meeting in April. So that's possible. I think the market is wrong. Sometimes that happens. The market changes its mind all the time. So you can't assume in these circumstances that like the Fed funds futures market is correctly predicting what's going to happen. 2 weeks ago, the Fed funds future market said there's not going to be a cut in December. Today, they say it's going to be at 90%. So, when you're a few months out, you can't assume the market has it right. They're just going on the information they have. So what's been going on between, Powell and Trump have been fighting. The basic year or so has mostly been about tariffs. Jerome Powell has said that he would be cutting rates if not for tariffs, because he believes tariffs are inflation. Why would he be cutting rates? Well, one, because inflation has come down a lot. We had inflation up at 9%, worst in 40 years. It's come down to around between 2.5 and 3%, and it seems to be on its way to 2%. The other factor that again, remember the Fed has this, what they call a dual mandate: employment on the one hand and inflation on the other. The other factor that the Fed considers when they're talking about this is the employment situation and hiring that has slowed down a lot. What's interesting is there's a couple interesting things about that. One, we actually don't know very well what's happened in the last couple months. We got a September employment report late. We're never getting the October employment report. We would normally get the November employment report this Friday, and we're not going to get it because of the government shutdown. It delayed the collection of data. It's delaying the processing of the data. So we're going to get the November data, but not for a couple weeks, actually. So it's normally out the first Friday of every month. I think it's scheduled to come out maybe December 16th, if I have that right. Anyway, it's delayed quite a bit. So the Fed is actually kind of flying blind right now. They don't have a lot of the data they would normally have. They don't have all the inflation data they would normally have. They don't have the jobs data they would normally have. But over the past year, it's been pretty clear that businesses are hiring at a lot slower pace than they had been. What makes that interesting is there's both a push-pull factor in there. One, there are less workers available to the Federal Reserve. Donald Trump has been deporting workers. A lot of workers have actually self-deported. The border has closed. So instead of letting 100,000 people in every month, more or less, no additional people other than, the people who actually are giving visas are coming in. So the growth of the number of people you can employ has shrunk, which of course means that the number of people you're adding to payrolls is going to contract as well. But that's not necessarily a bad thing for the people who live in the United States. Yes, jobs aren't growing as fast, but the best estimates say actually right now, we probably only need around 30 to 40,000 jobs each month in order to not have the unemployment rate rise, in other words, to keep everybody more or less employed as they are now. And the unemployment rate is quite low. It's anytime you're below 5% unemployment, the economy is doing well. You don't actually want to ever get to zero. Just to make this clear, you don't ever actually want to get to 0% unemployment, because that's an economy that's not moving at all, right? My daughters joked about this at one point when the housing, I think it was right after COVID, and there was very low unemployment and very few home sales. And one of my daughters, she was like 10 years old at the time, said, "Hey, maybe we finally got it right. Everybody got the right house and everybody got the right job, and we don't need to do anything," right? But obviously that's not really the way the economy works. Nobody has the right house, for their whole lives. Some of us buy a house, we think we'll live here our whole lives. But then after 15 years, your kids grow up, they go away to college and think, oh, maybe I don't want to live here. I move somewhere warmer or smaller or cheaper. And the same thing with your jobs. You want there to be a dynamic job market in which some people are not working and some people are, and they get they move to a new job. They're willing to quit a job that doesn't fit them anymore. Dynamic job market is not 0% unemployment. Above 5% is probably a troubled job market. So you want there to be somewhere, call it between, probably healthy is somewhere between 3 and 5.5. It's a healthy job market. Much lower than that, you're in a problem. And same thing with inflation. You don't really, it would be nice. I know people would like it if there was 0% inflation, but if there's 0% inflation, you actually then run into the problem of, if something goes wrong in the economy, prices start falling. And that means anybody who stocked their shelves and paid a price 6 months earlier to buy the merchandise ends up losing money. The good thing about a 2% inflation, that might be too high. Maybe it should be 1%. But the good thing about having some inflation is you can stock your shelves and not worry that the stuff is going bad in terms of price right away, right? If you have deflation, if prices are always falling, then you better sell everything you have right away on your store shelves, because it's going to sell for cheaper in the future. That's not good for business, and it makes businesses hold back. So I get asked a lot, like, why do we want any inflation? That's the reason, because it can be punishing not to have any inflation. So Jerome Powell looked at the housing market the housing market is part of it, but looked at the labor market and said, I think hiring's been pretty weak. I've seen a small uptick in unemployment. I would be cutting rates if not for tariffs, but I'm convinced tariffs are inflation. And so therefore I'm holding back on cutting rates. I think this was an epic, colossal mistake. We have not seen tariff inflation. In fact, businesses are saying all the time that what they are seeing is that they are paying some of the tariffs. Importers, Walmart, Target, companies that sell a lot of imported goods say, we're paying some of the tariffs. Our suppliers are paying some of the tariffs by lowering their price, but we are not actually able to pass through our costs onto our customers. I think one of the reasons, frankly, is because people are so tired of inflation that when the business says to them, we're going to raise our price a little. People are like, okay, I'm going to go shop at your competitor. So again, like people say, well, why would Walmart absorb the cost? And let me explain why that is, because this is a question I get a lot. Walmart's a big company. Why wouldn't they just pass on the increased cost of tariff onto their customers? Well, because they have competitors. They have Costco and they have Target. And if they try to pass on the cost, if they say, we got hit with a 20% tariff on imports, we're raising our prices by 5%. Guess what happens the next week? Target takes out an advertisement in every local newspaper in America saying, we've cut our prices by 2%. Walmart's up by 5%. Come shop with us. So they are in the American competitive economy is actually causing Jerome Powell's thesis to be wrong.
John, can I ask
Yeah.
you a question about that? Why is Jerome Powell saying, I think tariffs are, I mean, what, isn't there data on this? Or can he look at the last, 6, 7, 8 months after Trump imposed tariffs and see whether it's been inflationary? Why is he saying, I think, in the abstract?
Right. Well, it's super, actually, really sort of makes me a little crazy, because you would think that after, Trump announced, first of all, Trump got elected and he said he was going to raise tariffs, right? So you think maybe prices would start to go up. Trump did his big tariff announcement on April 2nd. You'd think prices would start to go up. And you don't see it. So the Fed's theory is that this is just building up in the system, that these companies will eventually pass these through. The problem with that is it's an unfalsifiable theory, right? They can say that forever. It can be a justification for holding back on cutting interest rates, because you say, well, the longer prices don't go up, they're so certain that prices will go up. The longer they don't go up, the more they think that there's an inflationary pressure building up in the system. So they think it's like, your boiler rattling in the basement. It's not providing any heat to the house, but you can hear it going, and you're like, something's going to blow. That's what they're worried about. I think they should be more evidence-based. I think they should say, okay, we were wrong about this. It's very hard to do, though, if you have like dictatorial powers over the monetary policy to like actually admit you're wrong, especially when you were just wrong about inflation the last time, right? They got it wrong under Biden. They said we wouldn't have a big inflationary problem. Inflation would be transitory. It would go away. It's not going to become a big problem. So this time, maybe they erred on the side of caution. Like, okay, let's try to, and I'm being very generous to them right now. Let's ignore that, like pretend they're not political at all. And they said, well, we got inflation wrong last time, and let's make sure we don't underestimate inflation this time. But they made the opposite error. In other words, sometimes people say like generals are always fighting the last war. The Fed got inflation so wrong when it went up a lot. This time they got it wrong because it wasn't going up a lot. And I think that they should admit that it's not going to go up. And in fact, very recently there was an academic paper produced by the San Francisco Fed, a couple of researchers there, that looked at 150 years of tariffs. And what they found was, in fact, tariffs don't raise prices at all. They actually tend to lower them. The pressure from tariffs actually goes the opposite way, which is that it tends to actually raise unemployment a little bit and lower prices. Now, exactly why that happens, the paper actually isn't sure about. And it's a relatively new finding. I have my theories about why it's happened. They have their theories, but nobody's really sure yet. So I don't want to pretend like we know the answer. But Jerome Powell definitely has not come to grips with that yet. And in fact, he said a number of times, like, everybody I talk to says tariffs are going to push prices up. That tells you Jerome Powell doesn't call me, because I could have told him tariffs are not going to push prices up. In general, just to back up a little, when you raise taxes on a thing, it doesn't raise the price on a thing necessarily. It lowers the profits of the person who is doing it, because raising the cost of something doesn't mean that somebody has more money to spend on that thing. And particularly if you're talking about the entire economy, it's very hard to have inflation unless the Federal Reserve and the federal government are working together to grow the money supply. Tariffs don't grow the money supply. So it's very hard to have inflation caused by tariffs. Maybe you could get a momentary blip, but not really. I mean, even that I think is unlikely to happen. In fact, what we're likely to see is tariffs may raise prices of some imports. And I spent all of the first Trump administration tracking what happened to prices, and very few things went up in price, including things we were importing from China, including steel and aluminum, things made of steel and aluminum. Now, things went up in price farther out on the production, steel went up in price when you put a tariff on steel, but the products made of steel did. Same thing is happening here, where you're not seeing a lot of pass-through to consumers in terms of price. And where you do see pass-through, arguably we saw some in furniture. Now America used to be the furniture maker capital of the world. We were amazing at it. We let China more or less underprice that business and destroy it. Now, if you buy made in America furniture, you are wealthy, because it is very hard to track. You're buying it from somebody or you have a friend who knows how to do it. But it is very hard to buy made in America furniture for the average American today. And that is because we lost a lot of our domestic furniture manufacturing. So when we put tariffs on, furniture went up in price, but that is more than offset by other things that went down in price. So you don't actually see inflation, which is the general price level rising, right? It's not necessarily everything rising, but most things rising. Instead, what you saw is something that happens all the time in the economy, which is the prices of some things go up and the prices of other things go down. That's normal, because inflation is when everything rises more or less together. And for that to happen, you have to have an increase in the money available for people to purchase things. You can't have inflation without them. So Jerome Powell's been wrong. He will unfortunately, I do not believe he will be ever persuaded he was wrong. So I believe he will continue to be wrong until he is no longer Fed chairman in a few months. So his term ends. Donald Trump will get to appoint his successor. But that also has some complications, and I guess I'll talk about that a little. Donald Trump's gets to appoint Jerome Powell's successor as Fed chairman. However, he can only select a Fed governor to replace Jerome Powell. Normally, and that's something people don't realize, he can't appoint just anybody. That person has to be a Fed governor. Now, for all of the Fed's history, except for once in the 1940s and 50s, every Fed chairman who is also a Fed governor stepped down from their governor's seat when their chairmanship ended. So in other words, when the president said, I'm going to appoint somebody else, or the Fed chairman said, I'm done with being the Fed chairman, they didn't stay on the board of the Federal Reserve. They didn't stay on the board of governors. They stepped down. Jerome Powell has refused repeatedly, explicitly, to say he will step down from his governor's seat, which lasts for 2 more years, once his chairmanship, which lasts just until May, is up. That would be unprecedented. Frankly, I think reckless and irresponsible for him to do that, because he would be badly undermining whoever comes next as chairman, right? He would be I've called him uh, a shadow chairman, or actually I called him the shadow king. He would sit there sort of passing judgment over the chairman's decisions. He would be influencing the people who have been on the Fed with him for years, rather than the new chairman coming in and getting to set the agenda. But Powell hasn't said he'll step down. So there's only one seat that's definitely going to be open coming up. This is the seat that was abandoned by Adriana Kugler, who we didn't understand at the time, but she stepped down early. Her term went through January 31st. She stepped down this summer, and it wasn't clear why. We now know that she was under investigation for possible, I don't want to call it illegal trading, but trading that violated the Fed's rules. And so she stepped down because of that. Her seat was filled by Stephen Myron, who is the chairman of the Council of Economic Advisors, which is a sort of an academic advisory board to the White House. Stephen Myron has been serving he served at 2 meetings so far. He may be able to serve in December. His term, though, his seat, because he's filling out the end of Kugler's seat, that ends at the end of January. So that whoever Trump names to the seat currently occupied by Myron is most likely the person who Trump is going to name as Fed chairman, because they have to be a Fed.
So you're saying Trump is going to appoint the person and then immediately make them Fed chairman?
Oh, yeah, well, I mean, so that's happened before. So Powell already was a Fed governor, so he didn't have to be appointed governor and then promoted to chairman. But Bernanke was not a Fed governor. He was named governor and chairman all at once. But the point is, there has to be an open seat. There has to be an open governor seat. So we have the Myron seat, which will open up, and Trump could appoint the next Fed chairman to that. We also have Lisa Cook, who's a Fed governor who Trump had said he's trying to remove. That's before the Supreme Court. That seat could also open up, or it might not, depending on how the Fed rules. And so what we'll have then is possibly 2 seats. One question, though, is, does Jerome Powell stay? I think if he doesn't like who Trump appoints, he may stay. He may try to become a kind of resistance shadow king of the Federal Reserve. I think that's really dangerous. And Jerome Powell, if you're watching Empower America, you should be, but if you are tonight, you should step away. Don't do this thing that you're tempted to do. It would be very bad for the country, for the Fed, and for you and your long-term reputation. Step away.
I just have a question about that. So do you feel that Powell, is it simply that he wants power, or do you think, let me ask it this way. You've talked about this issue of Fed independence, right? Does the Fed operate independently? Are they serving on the orders of like the administration or not, right?
Right.
So couldn't the Fed be independent but biased? In other words, they're not a puppet of the administration, but they're biased toward or against the administration, and they work for or against them.
Yeah, no, I think that's absolutely a brilliant question, because I think that's exactly what we saw. I think the Fed was biased in favor of Biden's policies, which is why inflation got out of control. And I think they are biased against Trump's policies, which is why they have not been doing their work.
Is that why you think Powell might try to stay? Because of the bias? I don't think
Powell is personally power bad in like the sense of like an evil cartoon villain, in that like he doesn't want to give up power. I think actually what's happening with Powell is more of a traditional historical villain. And let me explain what I mean by that. Usually when people do great evil, not always, some people are just plain evil, but usually when people do great evil, it's not because they personally want power. It's because they have uh, adopted an idea that the only way to save the republic is by empowering themselves. And I think Jerome Powell really does believe that he needs to save the Federal Reserve, maybe save the economy from Donald Trump, and that there is a strong inclination that creates a strong inclination for him to not give up his seat and stay in power. However, I do think it might depend on who Trump appoints and what that person says to Powell, right? Like maybe whoever Trump appoints can persuade Powell to say, all right, this is a reasonable pick. I'm not going to undermine this and I'm going to step down. So if Powell steps down, Trump gets to replace Powell's governorship. He gets to appoint the new chairman. He gets to appoint whoever look, if Stephen Myron's been a great Fed governor, if I were Trump, I'd be very tempted to reappoint him for another 14-year term. And then he might be able to appoint the replacement to Lisa Cook. So Trump has a lot of appointments he could make that would be influential on the Fed. I mean, I think our Treasury Secretary, Scott Bessent, has been fantastic as Treasury Secretary. But if I were Trump, I would also think about appointing him, if not to chairmanship, I would appoint him as consider appointing him as chairman, but also to one of those longer-term Fed governorships because they are so long-lasting. This will be a legacy of Trump's, just like the Supreme Court appointments are, a legacy of Trump's that will last much longer than his administration. These are people who he will appoint who will be there for years and years on. So you want to make sure that you're appointing the best people you can come up with. And fortunately for Trump, I think he has, there's a full bullpen for him to select.
Wow.
So I've been talking for pretty long. If there are questions, I'm happy to answer it.
Okay, we have a question. From Dan. He has several questions here. First of all, do you think the Fed has way too much power to influence our supposedly free market economy?
I do. I worry that it's really hard when I explain to people in detail what the Fed does and how much influence it has, it's hard. It's hard to reconcile that with the concept of a free market economy. Unfortunately, I'm not sure that there's a lot of better systems out there. In other words, we went through a period of like free banking where there was basically in American history where there's basically no centralized control of banking, but that had tons of bank failures and the economy was very volatile during that period. I think maybe if what we really need, and this isn't something I know how to make a rule for, it's a more restrained Federal Reserve. One that says, we're going to try to set our sights on how the economy develops over the next 20 years rather than over tomorrow. I think that would be rather than over the next year. Like the fact that the Fed is bothered by the fact that we missed an unemployment report, right? Or that like another unemployment report might come late. That's too much recency bias towards me. I would much rather have a Fed that says, you know what? We're going to look at what we think the trends of the economy are over the next 10 years and make policy based on that, not make policy based on, last month's employment report. I think that's I don't think that's been a good system. The Fed hasn't been doing it this way for very long. And I think they could adopt a less, they call it data dependent. I would like them to be data dependent, but more on a long-term basis. I also think a thing that Jerome Powell began that was a mistake is doing what I call the standing press conference. 20 years ago, Fed chairman didn't even hold press conference. People had no idea what they were doing. People used to have to guess 30 years ago, people had to guess what monetary policy was. Is the Fed is the Fed being loosening monetary policy or are they tightening? People weren't even sure. Paul Volcker, Alan Greenspan would come before Congress and they would just like tell riddles and not say what they're doing. Bernanke, Janet Yellen did press conferences, but they did them sitting down behind the desk in a very academic way, as if they were explaining to a class or you were having office hours with them. Powell's innovation, I think, actually politicized the Fed in an unwanted way. His innovation was to stand at a podium like a politician, like a president, frankly, and say what he was doing. That, I think, both invites criticism from political actors, but also makes the Fed, in some ways, too prominent in our lives. I liked it better when they were behind the desk. I'm not sure I'd go back to the riddling of Volcker. Maybe, though. Maybe it was better. Or the riddling of Alan Greenspan, maybe that was better. I think the next Fed chairman should at the very least sit down during his press conferences.
Well, excuse me. Just 1 second here. Okay, so Dan continues. Why does the Fed own so many bonds they are not short term? It seems like they often do more harm than good.
Yeah, so what happened was the interest rate the Fed directly controls is an overnight lending rate between banks. It's called the Fed funds rate. And so if a bank needs to borrow reserves from another bank overnight, the Fed targets an interest rate for what the bank can borrow at that rate. Banks actually don't borrow reserves from each other anymore because the Fed actually there's so many reserves in the banking system, they don't need to do that. So now the Fed controls the short-term interest rate through something called interest on reserves. And this is, again, a very short-term rate where they pay banks an interest rate on reserve. But when the Fed lowered interest rates all the way to zero, either after the financial crisis or during COVID, they had a problem. They couldn't get the longer-term rates to fall more. So they bought a ton of the longer-term bonds in order to try to push to lower the supply of those, which would then lower the interest rates on them. And that worked a bit. It seemed to have lowered the interest rates on the long end, but it meant that the Fed had developed this enormous balance sheet that when they started to raise rates again, they actually lost a lot of money because they had bought all these bonds that were now underpriced in terms of the market. So, interestingly enough, in the last 2 or 3 weeks, I think, the Fed has actually stopped losing money. They were losing money week after week. They've stopped losing money recently. But when the Fed makes money, by the way, that lowers the government deficit because they pay their profits to the U.S. Treasury. They're probably not going to do that again until 2029 because they lost so much money that they're going to stay sort of unprofitable. They're not going to make back their losses for another 4 or 5 years.
Excuse me. So we have several more questions here. Better Fed solutions in other countries that we might adopt? They're asking, are there any better Fed solutions in other countries that we might adopt?
A lot of other countries don't have the dual mandate. In fact, we're the only ones that have both the maximize employment and control inflation. A lot of other countries have the single mandate central bank, which is control of inflation. However, it's not clear that they obey the single mandate. They actually seem to operate as if they have a dual mandate, which is to, basically keep the economy growing, keep unemployment from rising too much. So I'm not really sure anybody has it figured out yet. And I'm not sure that the formal rules you put in place only do this one thing, really constrain what the central bank does anyway. So I don't know if there's anybody else we can necessarily learn from. It may be one of these things that we just over time, need to work on and reform as we figure out, oh, yeah, we got very complacent, I'd say. We had low inflation for 40 years. And so that seemed like, oh, the Fed's really good at its job. But the problem with that is the very first time inflation started to creep up, the Fed got it totally wrong, right? Like the first time they were challenged, they got it totally wrong. And so my feeling on that is like, maybe the Fed wasn't that good over those 40 years. Maybe they were just lucky. We didn't have a lot of inflation. When it finally came around, they got it totally wrong.
Another question. Excuse me. By what overriding metrics can we identify a successful Fed term?
Sorry, you guys probably hear my dog bark.
That's all right. Do you want me to read that again, or?
No, I heard it. Yeah. So okay. I would say that what you really want to know, a successful Fed term, is a couple of things. One, did they control inflation? That's the number one thing I would want, measure them as. Did they control inflation? Number two, and this is something I think the Fed has a little less influence over, but did unemployment get out of control? And then the Fed has a couple other things that they do now that's not baked into their thing. Bank supervision. Fed failed dramatically at bank supervision in the years up to 2008, but they actually didn't have that much power either. We gave the Fed, weirdly enough, more power after the financial crisis to regulate banks. So I would also say that, has the financial system been safe and secure? So those are the three measures I would look at. How has inflation been? How has unemployment been? And how has is the financial system holding up okay? I would give Jerome Powell relatively good marks. We had a momentary flash of a crisis when Silicon Valley Bank failed. And there was a moment there where we worried, will this spread? Will there be contagion? Will people start withdrawing their money from local banks all over the country and putting them in the giant banks, which we know are too big to fail? And that's kind of a problem with our system right now is, whenever there's a crisis, people pull their money out of the small banks and put them in JP Morgan Chase, right? We avoided that from happening. So I give the Fed some credit. While it was not ideal that they bailed out like large depositors of Silicon Valley Bank, it did stop a systemic problem from happening.
Excuse me. Okay, we have another one. Could you take a moment to enumerate the types of major actions a Fed can take?
Sure. I mean, so the main thing Fed does at every FOMC meeting is raise or lower interest rates. Those are it's a very binary choice, right? Like raise or lower interest rates. However, inside of that, there's a couple things hiding. One, as I was saying earlier, the Fed funds rate, which is the main rate we all talk about all the time, doesn't matter that much at all anymore. It's really the interest on reserves, but they move that with the Fed's funds rate. So the interest on reserves is what they pay banks for their how much reserves they have in the system. So that rate, if that rate goes high, banks are less likely to lend money out because that transfers when somebody borrows money from a bank and then moves it to another bank, the reserves flow to the other bank. So if a bank can make a lot of money by just holding reserves and not lending money to somebody, then they're less likely to lend money. And so that's actually why the economy moves more slowly when interest rates go up, because banks want to make sure they're not depleted of their reserves by lending cash that then gets deposited at another bank and goes into the reserves there. So that's the number one thing. The other thing is the Fed does is, and it's now a normal part. They used to call it like extraordinary, but it's now a normal part of what the Fed does, which is buy bonds. The Fed used to have almost no balance sheet ever. They had like $500 billion of assets. Now they have $6 trillion, and they've decided that they're not going any lower than that. They're going to start building it up again. So the Fed, so that's the second or third, I guess, thing the Fed can do, which is buy assets or sell assets. And right now, they have been not selling assets, but letting them run off as as bonds mature. And they're about to stop that. They've stopped it, and they're probably going to start accumulating more assets again.
What are your thoughts on I'm just curious about our level of debt. I assume the Fed can decide that it's out of control and they're not going to allow us to, put more money into the economy, right?
Yeah. So, I mean, one of the two big things that Fed policy does is affect our mortgage rates, right? Because our mortgage rates work off of where 10-year treasuries are, but also affect the price of government borrowing, because when they influence what you can get, what interest rates are available in the private sector, that creates a competition for government borrowing. And when you can buy a mortgage-backed security for 7 or 8%, you're not going to buy a government bond for 4%. You're going to require a higher interest rate on it. So when the Fed raises interest rates, it raises the price of government debt. And the problem with that, though, is we have so much debt now that it actually doesn't work to discourage borrowing, because we're at the stage where we now borrow to pay off our borrowing, right? We are a chronic borrower where our deficit now, a large percentage of our deficit, a large percentage of federal spending, which means a large percentage of our deficit, now goes to pay interest on the money we borrowed already. So when the Fed raises interest rates, instead of making us borrow less, which it should, we actually end up borrowing more because our debt's more expensive. And so it has a perverse signal where we've borrowed so much that we actually end up raising interest rates, and that raises the deficit. That's a sign that you borrowed too much money.
But what I'm wondering is, doesn't the Fed have a sense of responsibility for?
Yes and no. They actually say they do have a sense of responsibility in that they are supposed to control inflation, and if they think that the deficit is high enough that it's going to be inflationary, they will raise interest rates. The two problems with that: one, they do try to not interfere with the spending and borrowing decisions of Congress, right? They try to say, like, we're going to make policy accepting whatever Congress does and not interfere with. We're not going to try to teach Congress not to do irresponsible things. And so that's part of it. The other problem is, then there is a bit of this problem when you raise when the debt level gets high enough, and then the Fed increases interest rates in an attempt to make government borrowing more expensive, to discourage government from borrowing. At a certain level, the Fed is actually raising money that the federal government is paying into the private sector. And it could, and this is controversial, it could actually become inflationary.
Yeah.
That the government is paying so much in interest into the economy that becomes its own stimulus and could become inflationary.
Mm-hmm. I remember on your interview this morning with Brian Thomas, you talked about the COVID debt, right? The COVID bailouts, and then I just wanted to clarify this: that level of debt, what do we do? An extra 2 to 3 trillion?
Yeah.
For COVID?
I mean, it was a leap up. That frankly, I read a bunch of articles in 2020 saying we should not worry about debt at all. We should borrow as much as we possibly can, that the reason why we have built up the full faith and credit of the American people, where we can borrow cheaply, nobody worries that they're going to not get paid back, is for a moment of crisis like this, where we have shut down businesses. We told people to not go outside, right? Like, we put the economy on hold. So it made sense to borrow a lot. What didn't make sense was that we didn't stop. Right. And this is always the problem, right? Once you get a government program running, it takes a lot to dial it back. And we didn't stop. And that's why we got the out of control inflation.
But so we increased our budget by the 2.5 to 3 trillion that year,
Yes.
2020 or
2020.
21. Okay.
Yes.
But my understanding is then Biden just sort of institutionalized that as our annual budget, right? Our usual, what was it, 4 to 5 trillion before
Right.
that?
Went up to 6 to 7.
Yeah. So how, if that increase in 2.5 trillion in the subsequent years wasn't spent on COVID bailouts, what do we spend that 2.5 trillion on?
Right. Well, so part of it was the Biden administration. Like, a good analogy is, the people who just never stopped wearing masks, right? Like they just kept it going. The Biden administration wanted to do that with the economy, right? So they just wanted to assume that there was a permanent crisis that permanently needed more and more, ever more government spending. So they spent like crazy on a zillion different things. Whether it was, they had, when you look at through their various plans. Now, fortunately, some of them they didn't get to do because some smart Democrats, including Joe Manchin in West Virginia, told them no, right? Like, okay, you've gone too far. You need to dial this back. But they were going for the whole thing. They would have been up at 10 trillion if they had gotten their way. And so like almost half of American GDP would have been being spent by the U.S. government at that point. They really went, they thought that the economy could just absorb it all. They were wrong. And then sadly, when inflation did start to rocket up, they looked at everybody else besides themselves. I remember it was like, oh, it's supply chain problems. Okay, fine. But then those went away and inflation kept rising. It was Putin's price hikes. Remember that one? It was Putin. So, you walk into a grocery store and you're like, hamburger went up just twice as much as it used to be. Did Putin eat all the beef? Right? Like, how could that possibly be a Putin price hike? Things that were just totally made in America went up in price. And you're like, I don't think Putin did that. I did like when people started to put like stickers around America that said like, I did that. And it was a picture of Joe Biden. That
Right.
was
The gas stations.
yeah, the gas station.
Gas pumps.
And look, I think we would have had a little bit of inflation coming out of COVID, because we did have this enormous government spending and we had interest rates very low. I think we would have had some inflation. We would have gotten up to like 4 or 5%. I think the reason why we got up to where we did, the worst inflation in 40 years, is because Biden wouldn't stop. And frankly, I don't think I think we all are very lucky that Donald Trump was reelected. I think if Biden or Kamala Harris had been reelected, they would have saw this as an affirmation of what they had done, re-engaged in the massive spending that they had planned and been thwarted at in their first term. Second term, especially if it had been Biden, so that you're not even going to be able to run again, I think we would have seen inflation go even higher. So in a sense, the American people, by electing Donald Trump, rescued us from much worse inflation than I think was coming under Biden.
Mhm. I wanted to ask you, I had mentioned this before we came on, so I wanted to ask you this question about our annual budget includes about $1 trillion to service the debt, right, that we have.
That's right.
Our 38 trillion in debt now. And I was wondering if that's just sort of now in the background, borrowing $1 trillion to pay off interest and principal on the debt. Is that sort of just like a low grade of source of a low grade of continuous inflation that builds
Yeah.
over time?
No, unfortunately, I think it is. And it means that it constrains what we can do in terms of cutting taxes because we need to be able to pay off our debt. We need to be able to make those payments. It constrains what we can do in terms of spending because the next crisis we get into, a war, a pandemic, something where we want to increase spending again, we'll be dealing with paying that interest. And that's really difficult. It's a reason why, like in a perfectly rational government, when things go wrong, you'd spend more. And then when things get better, you dramatically cut the amount of spending. We didn't do that. And so instead, we ended up with a much higher debt burden than we should. And it wasn't just Joe Biden, by the way. There's been a lot of periods over the last 40 years in which we probably should have cut government spending a lot because the economy was doing just fine. Instead, we kept it at a very high level. And as a society, I think the longer you keep all of these spending institutions in place, the harder it becomes to cut. We're seeing this right now, frankly, with the Obamacare subsidies, right? The Obamacare is broken. It cannot pay its own bills. The medical insurance, the health insurance that it provides is way too expensive for anybody in America to afford. And so we end up with these subsidies to fix the Obamacare thing. You try to pull away the subsidies and people are like, well, I can't afford that now. Yeah, because Obamacare broke it. That's a good metaphor for almost everything that's happened in our government for 40 years, where we break things, we replace them with government funding. Whether it's your local towns like community, you don't have a community anymore. They got rid of that. So now you have to build, you need government spending to keep people out of trouble, keep young people out of trouble, to keep old people from being alone. Just everything gets replaced with government spending and the debt just keeps growing.
Well, of course, I'm thinking back to the Bush too.
Yes.
I remember as a younger person who didn't understand a lot about economics, there were just basic things that were intuitive to me. Like, okay, so Bush, starting the two wars, creating TSA and DHS, and then cutting taxes. Clearly, we're going to have to, increase our debt. So he doubled the debt from 5 to 10.
And Medicare Part D, where he put prescription drugs onto Medicare as well, which was another big spending thing. And he really grew the Department of Education as well. So,
did he? Oh,
yes, yeah,
wow.
yeah.
But then Obama, I remember Obama ran as an antidote to that. He said, that's irresponsible. So he said, I'm going to cut our debt. And then he doubled it from 10 to 20. Yeah. And then in 2016, Trump ran on decreasing our debt, and then he increased it. At some point, I think at a lower pace, right?
Yeah, it grew more slowly. It's growing more slowly again.
Is it?
Yes.
Is it? Wow.
He has helped. But like I said, a huge problem is once you build the spending institutions, trying to cut them is really hard. The vampires and government agencies are the only two things that are immortal. And one of those doesn't really exist.
Lord. So I'm just wondering, we only have a couple of minutes left, but what is your sort of prognosis on the level of debt? I mean, what I was trying to say here is that clearly, then Biden increased the debt and now Trump's increasing it at a slower rate, right? But what's your prognosis on the debt? I mean, it seems like everyone promises to cut it. They don't cut it. Congress is irresponsible. What do you think is going to happen?
So I think we can grow our way out of the debt. What we need to do is grow the economy at around 3% a year and grow the debt less than 3%. Then it takes, so in other words, you have two lines, right? They're going up, and right now we've had debt going up this way and the economy going this way. What we want to do is switch the angle. So the economy grows faster than the debt, and then you can start to pay it down. So the key is faster economic growth. And I think the key to that is shared prosperity in America. And I think the key to that is basically the Donald Trump economic program, which is tariffs, low tariffs, somewhat cuts to government spending, cut taxes to encourage business growth, and lower immigration so that the American people who are here are able to be as prosperous as possible. I think that's how you pay off the debt.
So you feel like, Trump really is laying the groundwork for
I am.
that.
And I'll just tell a very personal story. But the bio you told is a little incomplete. I actually, my life didn't begin as a corporate lawyer, obviously. I was a political activist in the 1990s. I worked for Pat Buchanan's presidential campaign in 1992. I was very young. In 1996, I was still pretty young. In 2000, I was a law student and I did some help there. And I left politics after 2000. I became a corporate lawyer. I thought that we were done. America had made the wrong choice. We'd given into, we had allowed China to accede to the WTO. As you were pointing out, like our debt just kept growing. Our government kept growing. George Bush engaged in these insane wars. I just thought, you know what, I'm going to take a job and be a corporate lawyer. Then I started writing about finance a couple of years before the financial crisis because I could see that the financial sector that I had gone to work for instead of doing politics was also going off the rails. And that went off the rails. And so I was pretty despondent. I left politics. I thought the financial sector was permanently broken. And then Donald Trump came around. And this is the most hopeful I have been in 30 years. And so I just want to leave everybody with that. I think we are finally on the right path. If I were to write a book about this era, it would be called The Fall and Rise of the United States. And we're on the rise.
Well, that's comforting.
Glad to, I want to hand out an up note. So.
Yeah, no, I appreciate it. John, thanks so much. It was great. We really appreciate it. We really
thank you so much for having me. I hope we get to do this again.
Yeah.
Maybe when we get the new Fed chairman, you guys could have me on.
That'd be great. Yes.
Awesome.
Thanks so much. To our audience, I just want to remind you, on Thursday, you can live stream the TPUSA meeting if you'd like to, and go out and empower you. We'll see you soon.